Welcome back to another edition of Our Economy Today. Hard data that matters now. It is Friday, August the 25th, 2023. From the desk of Christopher Walraven, we're talking about the housing market. Yesterday in Business Insider, there was an article where Fannie Mae stated the housing market will be stuck in a rut for a long time, even if the U.S. avoids a recession. Now, who is Fannie Mae and what importance do they have to the market? They are instrumental. Even the National Association of Realtors will tell you how important they are to the mortgage sector. And without them, there would not be the housing market that we have today because they are the driver. Remember in 2008, as the economy was crashing, Fannie and Freddie were going insolvent, and they are a government-sponsored enterprise. We ended up putting them into conservatorship, and that conservatorship is managed now by a new agency that was developed July 30th, 2008, was founded, the Federal Housing Finance Agency, which oversees Fannie and Freddie. So if you remember, the economy was so bad, there was no one out there to be able to support these mortgages, especially since so many of them had been packaged and rated as AAA by the credit agencies, and they were put in tranches, pieces. So they were rated excellent, but there were only a few pieces of excellence mixed in with garbage. So the government had to come in and bail that out in the primary market, because the secondary market is where the lender then pushes those down to Fannie and Freddie. They package them into these mortgage-backed securities, and then they're sold off to Wall Street. Now, the Federal Reserve has been buying a lot from the primary and secondary markets since 2008, and until recently, while interest rates were down, it's the Fed that's doing that because they do that through the process of the open market. And that open market process allows this system that you're looking at. Here it shows the primary mortgage market, the lender, the borrower, and the secondary market. When those lenders bring in those borrowers and they are approved for a mortgage, they have to meet certain underwriting and product standards. Once they do that, they get down and put in Fannie and Freddie, they get packaged, and then that's when they're sold off to Wall Street, or as you know, the Federal Reserve was buying $85 billion some months, sometimes less, who knows, probably sometimes more. But without them buying into the system, there would not have been a housing market because they were providing the liquidity, the cash. So what happens is they buy those mortgage-backed securities from the lender or from Freddie and Fannie. They put that money back into the system, issue new mortgages to the consumer. They're packaged up again. That money then is bought off those books by the Federal Reserve. The Federal Reserve then inflates more money into the system. And because they're buying these bonds, the long end of the treasuries are suppressed. That kept down to allow interest rates to be kept low. Now, to slow the economy because of this inflation, housing markets went way out of proportion. We have seen the Fed stop buying. And that's where the open market operations comes into play. And there's the Federal Reserve webpage, and you're looking at it. And here it is more simple than the Fed leads you on to believe. If you're going to lower interest rates, you're going to go out and buy those government debt, driving down those borrowing costs. And if you're going to raise interest rates, you're going to quit buying government debt. You're going to sell it off, those bonds, thus raising the rate. So quantitative tightening is happening now, causing the market itself to see increase in those interest rates for housing. Now, who is the largest lobbyist in DC? You may say pharma, but pharma is way down there when you consider dollar amounts. Number one happens to be the National Association of Realtors at 81.5 million, then the U.S. Chamber at 79, and then pharma is down at 28 million. So you see how important the Fed is and the government in keeping the housing market moving. We know that without the Fed, there would have not been the liquidity, the cash to buy the houses, because they keep reinflating the lender. So the lender then can loan that out and keep housing moving. And the Fed was keeping the long end of the treasuries low, so interest rates were kept low. Those interest rates are coming up, and now housing is slowing, but it should, because when you print all this money, it artificially inflates asset prices. And the reason people are seeing housing where it is at this high price is just not the basic consumer. But after 2008, we had institutional investment firms come in and buy real estate. Here's Amherst. Amherst on this page shows you they have 55,000 homes, 243,000 residents. These are freestanding homes in neighborhoods, possibly yours. They also wanted to continue growing the housing market, that in 2021, as you can see from the Dallas Morning News, they bought a factory where they could pre-build homes. And here's the article as you see me scrolling through it. But let's jump to see some of the other competitors are that have tens of thousands of homes. If you look here, for instance, under this Yahoo Finance article, American Homes for Rent out of Calabasas, California, has 59 single family units across 21 states. And you say, well, maybe this is just low income and maybe middle income neighborhoods. No, look at Invitation Homes. They're based in Dallas. They have 80,000 homes. The median income for a family of four in 2021 was 70,000. Look at what its new residents have, an annual income of 134,000. And these are in desirable neighborhoods, as this article says, across the U.S. And it is one of the largest landowners of single-family homes in the U.S. They own these. They're in HOA neighborhoods. Talk to some of the HOAs. They're not very happy they're there. So they drove up the price too. So when you were competing and trying to make sure you could get into that house, and especially as they were increasing, you wanted to get in thinking you were going to miss out, these institutional investment firms were pushing the price up for you. Here is Credit Karma. There's a report on income. Here's where that median household income information came from for 2021 at $70,000. Right here you can see it. Average personal income climbed to $64,000 in 2021. But remember, Invitation Homes, that Yahoo Finance article, $134,000. Today, we're going to look at St. Louis Fed. This is directly from them. At the end of the Q1, which first quarter of 2003, there was $19 trillion in outstanding mortgages. Remember GSEs, which are Fannie and Freddie, and you have also Ginnie Mae in there, which happens to be under the Agency of Housing and HUD, which is different than housing, the Federal Housing and Finance Agency, which was just developed. So what can happen is the GSEs can go back out if they ever get out of conservatorship and start trading, because they were publicly traded prior to the 2008 collapse. They just haven't been released all these years. The government, I guess, feels like the housing market wouldn't be stable if they were out on their own, so they've been kept in-house. And there is a Government Accounting Office report here in front of me that even states the federally owned corporation of the Mortgage-Backed Security Agency that has issued 95% of the MBSs since 2008 are backed by Uncle Sam. So where could you go wrong if you were a lender? You got money, the MBSs were bought by the Federal Reserve, new money was put into your bank, and also interest rates were kept low to drive housing. So the Fed gave us low interest rates, all the liquidity we needed. They realized they blew this bubble up, so then they have to bring it back in, and now we're all suffering on the other side with inflation across all asset classes. Go to the grocery store, and housing is going to have to correct, and unless institutional investment firms keep buying in and pushing the housing prices up, it's going to end. But why would they do that? Their business model is broke now. When 60% of the population can only come up with $400, how can they continue to drive rents up? and they need those rental income to pay their investors, because that's where their returns are coming from, are the rents. And if rents are going down, how can you continue to meet or exceed the expectations of your clients that bought these packaged projects? Remember, it's a REIT running Invitation Homes, for example. They do have to put a percentage of their money back in to that REIT, but as things slow, there'll be less and less money going into them. They may try to sell off some of their units, which will then bring down pricing also. So it needs to get back more in line where the average person, 28% of their income maximum goes to pay for housing. That's not me saying 28%. That's been the rule that's been out there for decades. That's the issue on housing today. I've rattled on long enough. So until next time, have a great day.